We've already dug into Indo-MIM's revenue, their profits, the balance sheet, and those cash flows in our previous breakdowns. But let's be honest, raw numbers on a ledger, they don't always tell the whole story, do they? We need to know how profitable is the company relative to the actual capital they've invested. How efficiently is management utilizing their assets? Exactly how much leverage are they carrying on the books? And maybe most importantly, are those paper profits actually converting into tangible financial stability? Well, this is exactly where financial ratios become absolutely critical. Today, we are turning Indo-MIM's raw financial statements into a dynamic, objective financial health scorecard. Welcome to Part 12 of our Draft Red Herring Prospectus Explainer series. All right, let's dive right in and decode the underlying mechanics of Indo-MIM.
So from our previous analysis, we already know the top-line story. We've seen their revenue from operations grow consistently, hitting over 33 billion rupees by fiscal 2025. But to really understand a business as a prospective investor, we have to ask a much deeper question. How efficiently are they actually utilizing their invested capital? I mean, growth is one thing, right? But profitable, capital-efficient growth, that's the real hallmark of a resilient enterprise. In this explainer, we're going to look strictly at the consolidated financial metrics provided right in the DRHP to answer that exact question.
Here's the game plan for today's explainer. We'll start with why ratios matter, take a look at our baseline dashboard, move into tracking profitability and capital efficiency, check out their liquidity and leverage, and wrap it all up with a final health scorecard.
Section 1. Why ratios matter. The financial medical checkup.
Think of it like going to the doctor. A doctor doesn't just check your overall weight, they check your vitals to diagnose your underlying health. It's the exact same for financial analysts. A company might have massive revenue, but if their margins are razor thin and their debt is unmanageable, they are basically heading for financial cardiac arrest. And what's absolutely crucial here is the concept of time. An isolated ratio just tells you where a company stood on one single day. But businesses are living, dynamic organisms. To get the real narrative, we have to analyze how these metrics trended across fiscals 2023, 2024, and 2025. This three-year view is going to show us exactly how the company responded to operational challenges and whether they're actually getting more efficient as they scale.
Section 2. The Financial Ratio Dashboard. Baseline Vitals for Fiscal 2025.
Before we get into those historical trends, let's take a snapshot of the patient's most recent checkup. This dashboard matrix gives us a fantastic baseline reading, pulled straight from the DRHP. At the close of fiscal 2025, we're looking at an EBITDA margin of 28.01% and a profit after tax margin of 12.73%. On the capital efficiency side, return on equity is sitting at a healthy 19.94%, and return on capital employed is even higher at 23.51%. Down in the risk categories, we've got a debt-to-equity ratio of 0.57 times and a current ratio of 1.72 times. Now, at first glance, this paints a picture of a highly profitable company with pretty manageable debt. But to really understand what's going on under the hood, we need to break these down one by one.
Section 3. Tracking profitability and margins. Are they making money efficiently?
Let's dive deeper into profitability. We want to know how much cash they're generating from their core manufacturing and global sales, way before the accountants start deducting non-cash expenses. So we start with the EBITDA margin. Based on the DRHP, this is calculated as earnings before interest, taxes, depreciation, and amortization divided by revenue from operations. Now, why do analysts love this metric so much? Because it shows us pure operating efficiency. It tells us exactly how much cash the core business makes from every 100 rupees of sales, completely stripping away the noise of interest on debt, taxes, and non-cash expenses like depreciation on all that heavy manufacturing equipment.
And look at this chart. It brilliantly illustrates the operational narrative of the last 3 years. We're seeing a very clear V-shaped trend here. In fiscal 2023, Indo-MIM posted a massive 29.06% EBITDA margin. Then, in fiscal 2024, those margins compressed down to 25.90%. But they didn't stay down for long. In fiscal 2025, as their revenues climbed to over 33 billion rupees, their operating efficiency bounced right back, pushing the EBITDA margin up to a really robust 28.01%. This strongly suggests they have excellent pricing power and cost control at the operational level.
Okay, now let's look at the ultimate bottom line, the PAT margin, or profit after tax relative to revenue. Here the story has a bit of a twist. We see that same dip in fiscal 2024, dropping from 17.18% all the way down to 9.88%. But look at the recovery in fiscal 2025. It only climbs back to 12.73%. It's definitely lagging behind that strong EBITDA recovery we just saw. So what happened? Well, the DRHP explicitly points out a major exceptional item in fiscal 2025. There was an impairment of property, plant, and equipment at Triax Industries amounting to over 1.03 billion rupees. That is a massive non-cash impairment hit to the final net profit, which perfectly explains why the PAT margin looks a bit more subdued, even though the core operations are actually humming along at 28% efficiency.
Section 4. Capital efficiency, ROE and ROCE. Are they using investor and debt capital wisely?
High profit margins are fantastic, sure, but now we have to ask the next logical question. How efficiently is management deploying the actual capital provided by shareholders and lenders to generate those profits? Because a company can have high margins but require massive, inefficient amounts of capital to get there. So we start with return on equity, or ROE. The DHRP calculates this as the restated profit for the year divided by average total equity. For an equity investor, this is the ultimate test. It's essentially asking, for every 100 rupees of net worth that belongs to the shareholders, how many rupees of net profit did the company spit out this year? It's a direct measure of how effectively management is using your piece of the pie.
Taking a look at Indo-MIM's ROE, it perfectly tracks that same fiscal 2024 operational dip. In fiscal 2023, they generated a stellar 25.37% return on equity. That took a sharp drop to 14.01% in fiscal 2024 as profits contracted. But they staged a really solid rebound to nearly 20%, 19.94% exactly, in fiscal 2025. And keep this in mind, they achieved that nearly 20% return even after absorbing that 1 billion rupee impairment hit to their net profit.
Next up is ROCE, or Return on Capital Employed. The DRHP calculates this one as earnings before interest, taxes, and exceptional items divided by total capital employed. Now, while ROE only looks at the shareholders' money, ROCE widens the lens to look at the broader picture. It measures the returns generated across both equity and debt capital combined.
Because ROCE strips out taxes in those one-off exceptional items, it honestly gives us the clearest possible view of Indo-MIM's core manufacturing efficiency. And folks, the numbers here are incredibly strong. Indo-MIM's ROCE proved to be highly resilient. Even during that operational slump in fiscal 2024, it only dropped to 19.59%. And by fiscal 2025, it had climbed right back to a robust 23.51%. Let me tell you, generating over 23% on total capital employed in a heavy, capital-intensive manufacturing industry, that is a massive indicator of capital discipline. So the crucial takeaway here is understanding the dynamic between the two. When you compare them, the fact that ROCE stayed so much higher than ROE during the fiscal 2024 downturn is super important. It tells us that their underlying factory floor operations were still highly efficient despite the pressures on their bottom line net profit. Basically, the capital they deployed into the actual business was still doing its job incredibly well.
Section 5. Liquidity and leverage levels. Can they survive an economic shock?
Strong returns are great, but if we're doing a full checkup, we absolutely have to look at leverage and liquidity. Can this company pay its short-term bills? Are they taking on way too much debt to fuel all this growth? We start with the current ratio. This measures short-term liquidity by simply dividing current assets by current liabilities. Anything above 1 means you have more short-term assets than short-term debts. Back in fiscal 2023, Indo-MIM had a very comfortable ratio of 2.49 times. But over the last 3 years, you can see this steadily tightening, moving to 2.04 and then down to 1.72 in fiscal 2025. Now, a ratio of 1.72 means their current assets still comfortably exceed short-term obligations by 72%. So they are highly liquid for sure, but the trend clearly shows they're running a tighter ship on working capital than they were a couple of years ago.
Next, let's look at leverage through the debt-to-equity ratio. It's calculated exactly how it sounds. Total debt divided by shareholders' equity. This tells us exactly how much financial leverage Indo-MIM is carrying relative to its net worth. If the ratio is 1, they have equal parts debt and equity. The lower the number, the more conservative the balance sheet. The DRHP data shows their leverage is steadily creeping up over our 3-year window. From a very conservative 0.40 times in fiscal 2023, it rose to 0.53 and then to 0.57 times by the end of fiscal 2025. This lines up perfectly with what we saw in the balance sheet data earlier. Their total borrowings grew from roughly 8 billion rupees in fiscal 2023 to over 12.4 billion rupees in fiscal 2025. They're definitely utilizing more debt to finance their expansion.
But listen, taking on more debt isn't inherently a bad thing if you're generating the cash to pay for it.
And this is where the debt service coverage ratio, or DSCR, comes into play. This measures the cash flow available to actually pay those current debt obligations. Despite carrying more total debt, Indo-MIM's ability to service those loans improved significantly in fiscal 2025. The DRHP notes that their DSCR jumped from 1.39 in fiscal 2024 to 1.99 in fiscal 2025. The company explicitly links this positive variance to an increase in earnings combined with the reduction in principal and interest repayments due that year. So yes, they have more debt, but they are generating way more than enough operational cash to cover it without breaking a sweat.
Section 6. The Final Health Scorecard. The prognosis based on the DRHP.
Let's bring all of these diagnostic metrics together for our final prognosis. Overall, the DRHP reveals a company that successfully navigated a pretty complex environment over the last 3 years. After taking that dip in fiscal 2024, they executed a textbook V-shaped operational recovery, pushing those EBITDA margins right back up to 28%. They maintain incredibly strong capital efficiency, generating a 23.5% return on capital employed. Now, it's true, they've allowed their financial leverage to expand slightly to a 0.57 debt-to-equity ratio, and short-term liquidity has tightened a bit. But as we just saw, their fundamental ability to actually service that debt has gotten significantly stronger. Basically, this is the scorecard of a profitable, well-capitalized manufacturer that is managing its growth aggressively but still well within safe parameters.
So, what's the big takeaway? The ultimate question for prospective investors moving forward is this. As Indo-MIM expands globally post-IPO, potentially armed with a lot of fresh capital, how will management balance this fantastic 23.5% capital efficiency with their slightly tightening liquidity profile? Can they maintain those 28% EBITDA margins as they scale up? The numbers in the DRHP prove they absolutely have the operational engine to do it, but we'll have to watch those quarterly ratios closely to make sure the engine doesn't overheat. That wraps up our deep dive into Indo-MIM's financial ratios. Thanks for joining me for this explainer, and I'll see you in the next one.